All right. First things off, this will be recorded. And one thing I always say at the beginning of these webinars is when you get this in your email, after watching this webinar, watch it again, you guys, because it will really help things sink in, especially like last week, we ran over a bunch of option strategies within one webinar. And I know I kind of blew by or blew over a couple of you guys by talking so fast, but I had so much to get in there and felt like I really missed out on a lot of things that were going to be really important to you guys. I thought we'd make this into like a 3-part series, and so we can really drill down on each one of those components and give them their justice, because I just felt like I went a little too fast and may have lost some people. So I don't want that to happen. I don't want you guys to get into these strategies and not really feel comfortable putting them on. So we're going to start drilling down on these for the next couple of weeks, I should say. And we'll be going over the call spreads today. So this is option strategies to take advantage of earnings. We're going to just kind of drill down on these and build these out as we go along. Many of you may know my name's Eric Wilkinson. Some of you may recognize me from Fox, CNBC, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. I'm not here to tell you that I'm going to make you rich or make you millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, manage your own risk. At the end of the day, if you're paying somebody to invest for you, that money that you're paying in basis to those people is really money that you could be paying yourself. Even if you make some mistakes along the way, believe it or not, they're making the same mistakes. And if you've gotten a financial statement lately, you can tell that most of those funds did not do very well in the last couple of months, where there were so many opportunities, especially trading options, that you could have really paid yourself, not only by making those mistakes, but recapturing some of that basis and then reinvesting that. And over the course of 10 years, that will make a tremendous amount of difference. And I've traded in most markets throughout my career. I've traded everything from stocks, financial futures, commodities, currencies, and options on all of those products, and in most market conditions. Something funny today, I still get the sweaty palms every now and again when I'm putting on trades, and we were having a laugh about it. Is it that I'm trading too big? No, it's just that excitement sometimes that you get by putting on a trade. So that never seems to go away even after 25 years of trading, which is what really keeps me going. I got to go over a little disclaimer here. This is any any opinions, news, research, analysis, or other information contained here, or material provided by ProTrader Strategies and associate companies or employees, is for general commentary. The reason why I can't give you guys a particular strategy or a particular underlying, because I don't know your guys' risk parameters. I don't know what's in your portfolio. So therefore, what I'm talking about could be counterintuitive to what you're doing. So take these different strategies, play around with them a little bit, and implement them into your own portfolios, but do that in your own way. That way, you will feel comfortable with what you're doing, and you will be better off for it in the end, rather than just doing what I'm doing all the time. And please remember to do your own homework, and remember that past performance of any trading system or methodology is not necessarily indicative of future results. And like I said, this is going to be on earnings trade setups. This is going to be specifically for naked calls and call spreads. So it's going to be maybe a little bit of a refresher for some of you guys, but I really wanted to get into some of the details on the profit and loss and what you're really risking. That was something that I kind of went over really fast last time, and don't think that I really gave it the right justice. Again, we're going to be looking for volatility collapse. You can be directionally wrong when you have high implied volatility percent and still make money. And I'm going to show you guys an example. I took some screenshots of Disney yesterday, and if you would have sold the out of money call that was outside of the predicted market maker move, you could have gone into the money on those call options and still been profitable. So that is a huge advantage of making sure that when you're trading these options that you have high implied volatility, because when that volatility collapses, or we used to call it on the floor, you get volatility crush, that's where you really can make your money quickly. And we're also going to be trying to take advantage of theta contraction. The closer to expiration we get, the faster this theta contraction happens. And what theta contraction is if you can look along this line here, 98 days out, you can see that this theta does not really decay very quickly. But as soon as you get inside of this 45 days to 7 days, you get 50% of that theta decay happening, and then it really starts to happen 7 days to 0. And we're going to be trying to take advantage of this right in here. I like to cover my long-term trades somewhere out in here, just take 50% of my max profit. But when we get inside of this, we are looking to get all of our money out of it for the most part and cover it right away. Kathy, do you still expect a sell-off in Disney after earnings? A lot of that sell-off that happened had to do with a call that the CEO made and gave basically everybody a warning. So I think that earlier price before the earnings was kind of all baked in. That's why we saw that big rally right afterwards. And Disney today rallied a bit. We did a webinar on a poor man's covered call several months ago. I think it was in 7/17, I think was the date on it. It was when we first did our poor man's covered call. And so I'm long Disney as part of my core position for the most part, and I've just been selling calls against that. And I think on those August 24 lows is when I added to that Disney position. So now I'm long 2 long dated calls and short 2 calls against it. Today I did do yesterday I did some call spreads thinking that it was going to sell off, and covered them immediately this morning and got a little bit lucky. But we'll go into that a little bit more detail later. So we're going to try and take advantage of this theta decay that happens, and I'll show you the volatility, what happens with the volatility contraction. But great, thanks for asking, Katie. And we're going to need to figure out the market maker move, because something like in Priceline, which is a big high flyer, big boy jumbo stock, I guess, if you will, it didn't give the market maker move what it was for today, and so you're going to need to know this equation, and it's very easy. There's some other ones where you're doing the square root of the number of days in the year and dividing all that. Listen, at the end of the day, this is about as accurate as any of those. And when we're talking 10 cents on a stock, at the end of the day, it's a guesstimation anyway. So that 10 cents really isn't going to make that much of a difference. And so you take the at the money straddle and multiply it by 0.85. So you're taking the at the money straddle, which I'll show you in a little bit, and you multiply it by 0.85. It's so easy. You can do it sometimes in your head. But we need to go over some rules that we're going to be looking at, and they're not hardline rules all the times, but they're pretty much a line in the sand, and I try and abide by them for the most part, almost all the time. This is a major rule. You must have volume and open interest in it. And there's got to be a lot of players in there, because if you're trading like a $25 stock and the bid ask is 20 cents wide, you just want to stay away from that. It's just to get in and out, you might be paying 40 cents, and then you're right, but you're going to have to give up such an edge to get out that you're just not going to make money. Whereas there's so many other stocks out there that you can trade that are 1 and 2 pennies wide, that's what you really want to go after. I'm being asked, what result do you get with the market maker move formula? What is its meaning? Great question, Andreas. The market maker move is what the options pricing is predicting will happen to the underlying after earnings. So for instance, Disney had about a $4.50 market maker move. So they were expecting that Disney would either move up or down by $4.50 after that earnings call. And it's usually pretty accurate. It's usually a little actually overstated, but something like for Priceline, the Priceline market maker move is right around $78 for the most part. You know, that being such a jumbo stock, I would usually add a little bit to that and say it would be about 100. And then if I'm doing naked strategies, I'm going to look to double that market maker move. So I would go for Priceline $200 out, or maybe $150 out for the most part. Does that actually answer your question? I'll show you where you, I may have asked, where do you get the market maker data? Sometimes it's given to you and sometimes you have to figure it out. And I'll show you how to do that here in a little bit. And make sure, oops, sorry, I got a little ahead of myself. We need to make sure that we have high implied volatility. Like I said, you know, you want this to be above 50 going into the earnings, or don't trade it. And that is a hard line. High implied volatility needs to be above 50. You'll notice that a lot of times right before earnings, it's going to be about 100. So anywhere between 75 and 100. And that you need to make a hard line. Don't allow yourself to trade an earnings play where there's only, like, say, 30% implied volatility percent. And for the implied volatility percent, and I'll go over this a little bit again, but there's a numerator and a denominator. And on the numerator, which is on the top, you take where implied volatility is now, subtract that from the implied volatility low, and then on the denominator, on the lower side, you're going to take the high minus the low, and then you divide those two by each other, and that gives you what the percent is. And I'll go over that a little bit more in detail a little bit later also. And enter the trade at the end of the day, or at least in the last couple hours. You know, afternoon is sometimes okay, but as you can see, like with Tesla, I got hurt on this one a little bit because in Tesla, the market maker move was $15, if I remember correctly, right around ballpark, let's say. And I put it on right around in here, and it was around noonish when I put it on because I had a lot of stuff going on at the end of the day. And sure enough, look at this. We have about a $30 move around between 2 o'clock and 3 o'clock. Or actually, this was about 2 o'clock to 2:30, right around in there. I can't remember exactly. I don't know why the time didn't come up on there. But had a massive move in there, and I had already put my strategy around the market maker move here. Now I had doubled that market maker move and gone a little bit even further. So I think I was up here around the 35. So, you know, I got pretty lucky with that one. So that's why you want to wait till right here, close to the close, because sometimes they will have a massive move, and that could throw off your whole strategy by, you know, $10. I would have moved my calls up $10 if I would have been able to hold out and do that at the end of the day. So that's why it's important to put these on at the end of the day. And again, take them off at the open. You know, for instance, with Disney, I covered my Disney immediately off the open. I put a couple of other trades in right before the open just to try and catch some of those financials moving this morning. But with Disney, first thing off the bat, I put in a couple of buy orders on my trades that I had in there. And I talked about those trades in the daily market commentary. So if you guys are getting those, make sure you watch those, because I tell you when I'm taking them off and stuff like that. And pick strikes outside of that market maker move. I kind of hinted on that before. I usually like to go 1.5 standard deviations out, or double the market maker move, which is about that double the market maker move is about 1.5 standard deviations. That's just how the math all comes together for the most part. And if you're wondering what the standard deviation is, these are standard deviations. So one standard deviation is about the 16 delta. So as you can see, 34% of the time it will stay in here, and that makes it about 84% of the time it will stay below that one standard deviation move to either direction. So for the calls, you would think on the upper band, this would be kind of the put side. So 84% of the time you will remain in this area down here, and about 84% of the time you'll stay up here. And 1.5 standard deviation is what I like to play around with. Sorry, this is a bit sloppy, but 1.5 standard deviation puts you at about a 10 delta for all intents and purposes. It says it's about a 9.2, but for the most part, a 10 delta is about a 1.5 standard deviation, just to make life simple for you. You can pick the 10 or the 9 delta. It's kind of neither here nor there for me. Is every sound? Mary, are you having trouble with the sound? Is anybody else having trouble with sound? All right. A couple of people are saying sounds good. All right. I don't know, Mary. I have it cranked up pretty good here, where I'm redlining when I talk sometimes, so or at least the thing says I am. All right, so I like to pick about that 10 delta, especially if I'm doing a naked strategy. If you're doing a defined risk strategy, you're probably going to have to go to about the 1 standard deviation or just outside of there. And that's about, on regular long-term strategies, I'm picking about a 33 delta. On these, I'd probably pick about the 28 delta for the most part. And that's right about where the market maker move has a tendency to fall. Now here is the Disney strategy that I put on. So I sold the Disney. I think I ended up getting these at about 25 cents. And then when I took the screenshot, it had come off a little bit. The market probably came off a little bit. But right here in the upper area right here is where the market maker move is. So you can see it's given here $4.70 for Disney. Now another way to do it is you can see it's trading around 12.50. So you pick for your straddle, let's just say the 12s, just for simplicity. So the 12s, you take the straddle, and the straddle is just the calls and the puts, right? So if you're picking the straddle, we're going to need to add those together. So we would say, let's say $2.83 is mid-market on that, on the calls. And then you add that to $2.27 plus $2.27. So that equals $5.10, and multiply that by 0.85. So that gives you about $4.30 for that math. And that is for, 1 day. So, that's pretty close for math anyway. I can't find my calculator on my computer. Let's see if I can pull that up for future stuff. All right, it's not going to give it to me. So that's how you figure it out. So about $4.50. So it's pretty close to that. They have probably a better algorithm than what I'm using, but I will tell you most times it does come out very close to what their market maker move comes up with. So, and if you look at this, if it was trading at $12.50 and you add about $9 to that, that's basically how I came up with selling my 121 strike on this. And as you can see, it's that 9 delta, which is about 1.5 standard deviations away. And that is on the naked strategy. Now for the call spread, on the call spread, I like to try and get at least around, 25 to 30% the width of the strike, which is you know, the 1718 here. So the 1718 is $1 wide. So I would need to collect around 25 to, I would like to collect around 30 cents. And for this one, I ended up selling these for, I think it was 28 cents. And on the open, of course, like you all know, we started really rallying and I had to cover them back for 21 cents. And on my other calls, I covered these for about, I think it was I sold them for like, or I bought them back for like 5 or 6 cents. I don't have that in my notes right now. But here's what I was going to talk about. If I can find my platform here, let's look up, see if I can get Disney on here. So volatility on Disney was up in the 60s. And let me close this so it doesn't confuse anybody. But if you look at this, so these are those 116 calls or even the 115 calls. They're at $1.60. So these 116 calls, okay, so this is the 7 and the 7. So the 116 calls the day before were $1, you know, 57 there, and went in the money. So this obviously rallied since earlier today. It was actually trading around $1.30, and they got pumped up a little bit at the end of the day. But you could have been in the money on those 115 calls and still, oh yeah, so the 115 calls were trading $1, this is right, about $1.80, and then you go into the money and you still made money. And that was from the volatility collapse or the volatility crush. This is what we call the volatility crush. When you're trading up here, it was above 50, I think it was around 60, and it just totally collapsed. Now, one thing with this Disney, and I've talked about this in other webinars, this is how you figure out your implied volatility percent, which is also given to you down here. So this is the implied volatility percent that I'm talking about that needs to be above 50. Well, as everybody remembers, back in August on the 24th, we had this huge massive sell-off. That's when the Dow collapsed like 1,000 points and then popped back. So going forward for the rest of the year, because this is, you know, an average, or you're figuring out the average for the whole year, this is such an outlier that I will have a tendency going forward to discount that. So that's why it's very important to know that fraction. And what I said was in the numerator. So if you have the, oh, I don't want to do that. Oh, I can't write on this. So on the upper half of the fraction, you take where it's trading now, 22.50, and subtract that from the low, which is 15. So you get 750, right? And 750 divided by the high, I'm going to discount that, divided by the high minus the low, so 38 minus the 15. So you're getting, what is that, 23? Is that right? Did I do that right? 23-ish. So 7 divided by 23 to get your, I don't think I did that math right, because I'm trying to do it in my head. So 2250 minus 17, so that's 7. 7 divided by 15. Did I do that right? Seems wrong. Oh, because, yeah, that's right, because it was trading up here. I'm trying to get it above 50, and that's not making sense to me. So, yeah, so that would have been well above the 50%. So if we did it the day before, so 31 minus the 15, so you're getting about 17, and then 17 divided by 28 or something. That would give you well above 50%. Now you can, if you wanted to figure out where it is now, 22 minus the 7 divided by 25, 24-ish. 7 divided by 24, so right around that 30%. So that's just ballparking it in my head. They're taking into account this being the high, but I've discounted that. So does that make sense? Thanks, Andrea. She gives me 23. But going forward, it's important to know this because you can discount. I mean, you can take a little bit of liberty, especially because everything is a little out of whack. Everything is below 50% right now, and to find trades, sometimes you can bend a rule and take out that outlier there. All right, people, does that make sense to everybody? On the implied volatility percent, how to figure that out. So that crush right there allowed this strategy to go in the money and still make money. So that's really important to note. Had you sold those 15 calls or 16 calls, which you went right around the market maker move, 17 calls, if you would have just sold those 17 calls, as you can see, went to 63 cents. So made about 60 cents on those. Almost 80 cents on those, actually. It is auto-calculated too, yes. It is auto-calculated, but as you can see over here on the side, I have the implied volatility percent a part of this. But some of these that are right around 40 or something might actually be above 50 if you discount that one outlier move, especially if they had a massive move, maybe even like Google or something may have had a huge spike on that day. Google's not a good example because they stayed high afterwards, but sometimes they will be low and then really spike up and then come back down, and it's just a way out of whack, and we'll send that implied volatility percent because the computer is going to add that high in. Okay, so you can look to discount that. But when you get that crush after earnings, like even here in Google, you can see the other day when we had that, it totally fell out of bed, and that strike that might even be in the money, you could still be making money because of that volatility coming out. So that's hugely important. So we could go to, this is another way to figure out your implied volatility, what's going to happen. So let's look at Priceline because they're going to have earnings coming out. And you can figure it out on this. So look, Priceline here doesn't give you the market maker move. So for figuring out the market maker move for Priceline on one day, when it doesn't give you, you got to pad it a little bit also. So I always pad it to the upside. So for this one, it's kind of wide. So let's just say 45 to 48, $1.50. So we're talking $46.50 is about mid price, just ballparking it. $4, yeah, or $46, yeah, $46.50, let's say. And then on the other side, this is showing it to be about $5 wide, so $2.50 higher, $6.50, so $46.50 again, which is about right. So plus $46.50 in your calculator, get the 93 times 0.85. So our market maker move is $79. So the market is predicting about a $80 move. This is also the market maker move. That's for the entire 7 days for the most part. So $90, you got to add that in. But we're only going to be doing this for 1 day. So our 1 day is right around $80. So for Priceline, as you can see, I put in a trade here and I went just a little over that move for the 1600, so I went up $150. So I basically, when I put this on, it was right around double the market maker move. I think it was right looking at 77 then. So I sold those puts, and it's right around that 10 delta, 9-10 delta. Okay. Now, if I were going to do this as a spread, I would probably have to move it down a little bit, and I would probably have been looking about $125 higher. So looking at the 1575s or something, and I would want to try and get around, this is a $2.50 move, so I'd want to get about 70 cents. You can see it's around 60 cents. I might bend the rules for that and go for the 60 cents to make my defined risk strategy. So that's going to be on that one. So I like to look at the double the market maker move though and go for that one. And those 1600s just look pretty good. Plus on the chart, 1600 is looking pretty high. But you can see with Priceline, they can jump easily from 117 or 1117 to 1217, so 1218. So that's another reason why I made sure I was outside that $100 move. At the end of the day, they went 1284, opened up at 1380. So another $100 move. They have a tendency to make that $100 move. So go back and check what they did on their earnings. One thing I am a little nervous about, and this is probably another reason why it gave me sweaty palms to do this. I sold these calls and Priceline for this particular webinar because it was really the only one that was closest coming out on Monday morning. I'm bullish on Priceline. They just have beat earnings for the most part every single earnings cycle since 2005 except for twice, and they barely missed when they did that. So Priceline has been crushing it ever since William Shatner sold his stock at $2 back in like 15 years ago or something, or 12, I think it was 2003 or something like that is when he sold his. But you can check it out and look at the monthly on this and start just flipping through it since like 2005. I think it was or maybe it was 2010. Sorry, last 5 years they've only missed twice. So it was right in here somewhere that they missed a little bit. Right there, they missed by 30 cents. That was in 2012. So I think it's been since 2010 they've only missed twice. So just keep that in mind too when you're looking at those. That does have a tendency to play into my thinking. If they're consistently beating earnings every single time, then that's going to be something where I'm going to be selling puts or put spreads in. But I wanted to get that in there for this one. Another one that we can look at, and hey, while we're in this, why don't you guys throw me out some stocks that you would be looking at coming up in this next week. There's a few of them. There's like Cisco, Macy's is coming out, Applied Materials is coming out. I think Kohl's is, but they don't have very good options usually. While I'm going over this, so the bear call spread or naked calls, your maximum profit, your maximum loss, and your break even are going to be the same way. As you're going to calculate them the same way as you would on the longer term one. So I'm not going to spend a ton of time on this because I'm sure you guys have all seen this before. But your max profit is going to be the net premium you receive minus your commission. That's your maximum profit. Now, I'm not ever looking to go for the maximum profit on these. I'm looking to cover these immediately just for about anything I can get. If I'm directionally right, I'm covering it the next morning. I'm getting out of it. I don't want to play around with it after that binary event. Anything can happen. The longs might start covering and they could come out with better than expected earnings and still sell off. But usually right there at the open, it's a pretty clean number, and that's where I like to get out. I don't like to mess around with it for the rest of the day. Just like what happened in Disney today. When I got out, it was really rallying throughout the day. So started out, as you can tell, it didn't, in the morning, it didn't, it wasn't that obvious. So this is in Friday. Sorry, let me move this out of my way. So, you know, right off the open at 8:30, they just started rallying to where then it kind of settled down. But, you know, I was able to get out in this first, you know, 15, what was it, in a 15-minute bar. So I basically just went to the market and paid up and just let it blast all, get me out. There's enough people in there right away, especially in these. You know, you can't really do that in something like, say, Kohl's, which is coming out with earnings on the 12th, because, you know, that bid-ask spread is pretty wide, and that's something that I wouldn't even trade anyway. If we just look at Kohl's real quick on the trade page. So they don't even have the weeklies either. But look, you know, it's a little bit wider because it's aftermarket, but it does have a tendency to, even for a $50 stock, to have 30-cent wide, 20-cent wide markets. But you can look at something like Cisco, you know, and Cisco has 4-cent wide markets. And I'm trying to think if I can think of one offhand. Macy's is another one that not a lot of people trade, but it's also a $40 stock, and it usually has a little bit better markets than this. It's usually about 11 cents wide, which is pretty decent, 11 to 15 cents wide, and that's about as far as I will go on a stock, is 15-cent wide. I don't like to go any further than that. All right? Does that make sense to everybody so far? Trying the bid ask, when I'm saying there's a lot of players in there, look for something that's tight bid ask, and a lot of players, a lot of volatility and open interest. So where am I? Volatility and open interest. So as you can see, there's a pretty decent amount of people in the weeklies for this. You know, something like Priceline, there is going to be a lot of players in there as well. It's going to load slow because there's so many things going on in there. But, you know, you can see there's a lot of open interest and volume going on in there. So pick something like that. And Priceline, you can get closer to the offer. I wouldn't always pick the mid price on something that's really wide like Priceline. You know, start ratcheting it down, because there's people out there that want to play in here. They just don't want to give up much of an edge. So you could start out well above the mid price and start ratcheting it down from there. Yes, well, not necessarily the strikes that have a ton. Being asked, should I take the strikes with the high open interest? You don't have to pick the particular stock with the high open interest, but just make sure there's a lot of open interest going on in and around where you want to get in on a particular stock. Like, for instance, these puts. Not that I would do these puts because they're well inside the market maker move, but, you know, there's enough players in and around there that you can get in and out. I mean, even with where I was, there's even a couple of, you know, yeah, I just happened to hit the 16. It's probably because it's the 1600 level that it just became a psychological level for everybody. But that does help too, to have the bigger ones. So, but you can tell they like to pick round numbers for the most part. All right. So, for instance, what I wanted to show you guys on this trade page, actually. So let's look at this. So theoretical price and market. So, and mark, which is kind of like usually just gives you the mid price. What you do here in this theoretical, I got to reset it because it's for the wrong date. So, for instance, right now, Priceline is, what is Priceline's? 67%. So right now, the implied volatility percent is 67. So what's going to happen on Monday is that we're going to see that crush happen in the IV. Didn't you say to choose stocks with IV above 75%? Price line is at 34%. Price line actually is above, is at 67%. I like to go at 50% above. Yes, I do like to go at 75% for the most part. That's the ones that I really want to look at. Macy's is doing that also. But anything above 50 is fair game, because you're going to, I would say 85% of the time, get that volatility crush that we saw. And even if price line goes down by 10% on this, let's just do a negative. So we can go, let's say it goes up 100. I don't want to, so it goes up 100 and we get that volatility crush that I talked about. So it drops by 20, like what was it? Disney dropped by 40. So this isn't unreasonable to think that it's going to drop by 20 in a day, and hit enter on that. So you can see that it goes up by 100, only drops by 20. So it doesn't seem right. Those seem to be a little expensive if it goes up by 100. So it's 1550. So you're going to lose a little bit of money on that if it only drops by 20, but if it drops by, say, 40 and goes to about 20, you're probably looking at it to be, you're making a lot of money there. So you're making the full boat for the most part. So if it goes down by, I don't know what may have happened. Oh, you know why? Because I didn't change the date. So it goes down by 20, and then the date is the 9th. That's what, so as you can see, it's going to be right around that mid price. So you could have it be directionally wrong. Oh, I hit reset. Goes up by $100 on the 6th. Change that to the 9th because that's the day that it comes out. Because we're also taking advantage of the theta decay that we need to account for. And hit enter on that. So as you can see, you're going to probably be right there at very close to what the mid price is if you get that volatility crush and you're directionally wrong. Does that make sense for everybody? Scott, did I answer your question? Today's, you know what you're probably looking at? Are you looking at, let me find a different chart because that one doesn't have the, are you looking at the very bottom where the implied volatility is? Let's see here. So what was it? We were looking at price line. Were you looking at price line right down here? 34. Yeah, that, Scott, is where the implied volatility is now. What I'm looking at is the implied volatility percent. So what I'm trying to do is figure, because every stock is a different beast. Some stocks will always trade here at say 34%, but their spikes are well above, up into the 70s, and then they only come down to about 34 again. So that would be the low. So what I'm trying to do here is I'm coming up with the rank, the percent, where it is in percentage terms of itself. Does that make sense? So that's why I gave you that one math problem. So I'm not going to have the numbers, but for instance, you're going to take the numerator and the denominator. So you have the numerator and the denominator, right? And I'm going to draw over everything. So in the top, you do where that percent is now. So you said it was 34%. So you're kind of take that 34 minus the low, which I don't know what it is offhand, but let's say it was 23. And let's say the high is, so I'm trying to do some math in my head to try and make this work out. So 7. So let's say that the high is 50 minus that 23, because then it's the high minus the low. And that's how you get your percent. So it's where it is trading now, which was, like you said, 34, minus the low, let's just say it was 23. The high is 50 minus 23. And then you divide those by each other. So it's essentially 7 divided by 27. That's how you come up with that percent. Yeah, so you basically do the now minus the low, divide that by the high, minus the low. And that gives you the IV percent. Okay? Does that make sense, Scott? Okay. Yeah. Where it's trading now really doesn't mean a whole lot, because every stock is in and of its own beast. Some stocks have a lot more volatility, like the Googles and Teslas. Those consistently have higher implied volatility because they're just more volatile, whereas like the blue chips are going to have consistently low volatility. So when volatility in, say, IBM spikes up to 50, and I'm just pulling this off the top of my head, I don't even know if it's right, but doesn't have a lot of volatility, when it spikes up to that 20, that could be 100% volatility for that particular stock. So what happens here, to figure that, it's important to play around with this theoretical price and mark, because you can really see how something like, let's even look at Macy's, because Macy's is a trade that everybody probably can do because it's about a $50 stock, won't take a lot of margin, and they do have the pretty tight generally for the weeklies. It's only 14 days left in the monthlies, so you might get a little bit tighter bid ask when the market's open, so that would be something to consider. Also gives you a little bit more time if you're wrong. But if we take this again, if Macy's comes out with earnings, we can figure out what their market maker move is expected. So you basically do let's just, for ballparking purposes, $5 times 0.85. Probably should be able to do that in my head. $4.25. So I would pad that a little bit, maybe go, since these are in 50-cent strikes, go $4.50 higher than where it's trading. So it's trading at $49. So the $43.50 is something that I would be looking at for my strategy. Andreas is asking, how do I catch those spikes? Well, the beauty of the binary event is the spike happens, it slowly goes into the earnings, or that binary event. Implied volatility is going to start ramping up, just because there's a lot more people coming in there, and volatility is inherent in that binary event. Now, when you're trading the longer term option strategies, you don't really know. You could be trading a high implied volatility and it can continue to go higher, which is difficult for your position if implied volatility continues to go up, especially on a short premium strategy type play, which is why you would never want to sell short premium below 50, and I wouldn't sell, you know, I wouldn't be playing around with it, you know, below 50 unless, you know, I can mark out that one high line. But I would never sell a short premium play in something below 35 even, or 10 for that matter. That's just, it's crazy because anything can happen, and, you know, 10% increase in implied volatility, it can wipe out all of your profits, even if you're directionally right. You could be short calls and the market just tanks, and that's usually where you see implied volatility happen, is when the market tanks. Implied volatility gets pumped up faster than when it's rallying. So you can be short calls, be directionally right, but I shorted those calls with, like, you know, 15 IV percent, and it goes to 50. You know, I could be $100 away and still be losing money because that premium just gets pumped up because of the IV. So never sell below 50% for the most part. I mean, that's a pretty hard rule. I bend it a little when it's like right around, you know, 49, 48, because I can take out that high line lie or move that maybe happens once in every 10 years. I'm not going to play around with it for the next year or so. I'll knock it out sometime. So let's say Macy's here goes down by 20%. Why is the theoretical price so wide? $140. All right, 48. Let's change that. So on Monday, let's say, or sorry, let's just say it happened. We can pretend that this happens in the next couple of days. I could probably even just do it for tomorrow. We can probably take that liberty. So let's say that Macy's comes out with earnings tomorrow, and I'm short our what was it, $4. So we went up to the 50, so the 53.50. So we're short at 86 cents. And tomorrow, with nothing happening, it goes to 80. But let's just say it rallies by $4. It goes up by $4. So the price goes up by $4. Now our adjusted stock price is going to be, you know, $53. But if nothing happens to implied volatility, you can see $53. It goes up to $2.24. But let's just say Macy's is trading at 97 IV percent. It goes down by 30 just to 60, which is easily conceivable. Now we can see you're going to get more of a crush than that. Theoretical price is $52.90. That price is going to, I increased implied volatility. If implied volatility increases, then we're going to get hurt, of course, but we want the negative implied volatility. Sorry, you guys. So you can see that it would come right to that price, $53. We're not going to really be losing that much money, maybe 10 cents or something like that if we were in that. But we saw with what happened with Disney that we could go into the money and we're still making money. So that seems to be a little off to me. You know, if it went down by 40, yeah, because Disney only went down by about 30 on the implied volatility, and it was still making money. So here would be a situation. It goes down from 97 to 57. We would be making money despite the fact that we were right there. And even if we went in the money, we would be making money. See all these ones that went into the money? I mean, you have to go down to 42. It'd have to be $2 in the money for the most part before we started losing money. Does that make sense to everybody, how that works? So that's why it's important to play around with that. So with Macy's, having said that, I am going to be looking at on Tuesday, because it comes out on the 11th. So Tuesday, and I think it comes out in the evening. So I'm going to be looking at these. So I'm going to be looking at just that. I'm going to hopefully have the market maker move here, but if I don't, I'm just going to go up here, pick the straddle. You can do this a little easier. Pick the straddle that's at the money, which would be the 49 straddle right here, because the $48. Oh, I don't want to do that. The $48.90 is closest to the 49 strike. So multiply that 450 times the 0.85, get your market maker move and go outside of that. I'm not too worried about selling calls in Macy's. I think they've been having a little bit of trouble as of late, just with the overall economy. It could be priced in, but I'm going to be looking to sell calls above this area. This has been acting as a resistance anyway, so I kind of look at that too. So I'd be happy selling those 43.50s probably, but I'm going to wait and see where the market tells me that when that time comes. Yeah, always wait. You guys always wait till right before the close when you're doing these. I don't like to put those in, especially in the early morning, because they can be moving around a lot. If you guys remember what happened with that Tesla, I mean, that can happen with any of them. And get that spike and it just outdoes the, oh, I don't know why that's going crazy. I thought I had it pulled up for the Tesla. Remember that Tesla move? It happened, it doubled the market maker move in the last hour of the day. So put that strategy on here and you will have a much higher probability of success, because put that strategy on here and do that market maker move, you're really becoming inside the market maker move at that point. And I just like to do the double the market maker move because I like to be outside of it. I don't like to be tested on going in the money. You're going to see that volatility collapse happen. Like I said, about 85% of the time, it almost never goes way up afterwards because the news is out. There's nothing else left to worry about. So that premium really sucks out. And the volatility totally collapsed. So yeah, I don't even know where Disney is on here anymore, but I think it went down to like 23, 24 after today. Probably look it up here easier. Does anybody have any WC asks why multiply by 0.85 to calculate the market maker move? You know how many times I've asked that same question, and I always get like, it's a given. It's one of those things that's a given in like geometry. It's the given, and it's probably a very detailed average of some crazy math problem where it's got the number of days and all of that, the square root of the number of days multiplied by the whatever. But that was one of the first things. This is something we used to do on the floor at the Board of Trade, and we didn't have all of these fancy things given to us. We would take the high implied volatility off of a piece of paper. We just knew where it was. And now we would know where it is. Now we'd have the historical stuff written down and just knew that. So we always had to know that equation, and then customers and stuff like that would ask, hey, what's the expected move on like the Fed day for the FOMC? And we would get the straddle, figure it out through the options at the money straddle, and figure out what our market maker move would be on that. I also would do the math off the where the month was and how much it was pricing in. So, for instance, like December's pricing in about a 25% chance of a Fed hike. So those are, they have all kinds of little like shortcuts to be able to do everything in your head. Because if you remember, you got a pen in one hand, you got your deck in your other hand, and you're like slapping out 100 lots or 25 lots, and you're doing hand signals, so you don't have something to pick up a calculator and do that. So we always just had something like, if the straddle was $5, you should be able to figure out, all right, 85, 5 times 0.85 and come up with 4 something. So I'm getting a question. Sorry, I have not understand what is the EOD before earnings day or the day of earnings. EOD, where did you see EOD? Is that part of here? End of day? Yeah, do it end of day. End of the day before the, if the earnings comes out in the evening or in the morning, I'm doing it at the end of the day. So for Priceline, it came out, it comes out in the morning, so I did it end of the day. Disney came out at the end of the day yesterday. I did it at the end of the trading day. So, somewhere between, you want to, in the afternoon, definitely, but after, 1:30, 2 o'clock is even better. If you can do it right at the close, then that's, even that much better. And one question I was asked yes, before the earnings. You want to do it before the earnings. I wouldn't even try and trade right on the open of earnings to put on a trade. You just want to have that in there, have your bet in, and watch that volatility contract. What happens if the price blows through your short strike? Then you're going to have to manage that. That's a possibility that it could happen if you're naked. Take it off and rip off the Band-Aid immediately. Take your losses, because you are going to have losses when you do these. I've gotten pretty lucky and have been able to scratch or make money for the most part on this earnings cycle. But when you're going twice the market maker move, that's 1.5 standard deviations out. It only happens maybe 10% of the time. So you're winning 9 out of 10 times. So you will have sometimes where it goes through your short strike, and you can either roll it out in time and collect a little more premium from the longer duration and keep the dream alive. But if your assumptions changed, then rip the Band-Aid off and take your losses. But I usually rip the Band-Aid off and move on, especially on an earnings trade. If I have a longer duration trade, then I have a tendency to roll it out and try and manage those a little differently. With these, I get done. And how to find good premiums. The best way to find good premiums is in the ones that have a lot of options activity. They're going to be priced fairly. So if you're picking that 9 delta, 10 delta, you're probably going to only be getting about 35 cents. So that's kind of where I look at it when I'm way out there. To collect something like Priceline, it's going to be a little bit more, obviously, because it's such a high flyer. But usually around like what was Macy's was if we look at that being the double the market maker move on Macy's. On straddles, and we said $4.50. So that's that. You're probably, that's a little close. So if you went double the market maker move, that's just on the market maker move. So yeah, you're probably going to go about 50 cents just inside that. And keep in mind that the market maker move is usually overstated because everybody's in there buying options, and that pumps up the premiums, which inflates that. And I think I heard a statistic one time: the market maker move is overstated I think it's like it says 64% of the time, but I saw a study that said it was upwards of 70% of the time the market maker move is overstated. So that means that the market doesn't move as much as the market maker move 70% of the time. I mean, even Disney today didn't, even though it rallied up to that 116 on bad earnings, it was still inside that market maker move. And I think even Tesla, the same thing. It had that massive move the day before that was double the market maker move, but after the earnings came out, it was inside that $15 for the move, I think. You can correct me if I'm wrong. But then, like I said, if I doubled the market maker move on this and went from 49 to $8 higher, 57, I would need to collect a minimum of probably above 25 cents. That's what I usually look at. I won't take less than 25 cents, or I'm just not going to do it. It's not worth selling it for, 13 cents. There's just too much risk reward there. Risk versus what your reward would be for 13 cents. After commissions and everything else, it's not going to be worth it for a couple pennies. Does that make sense? Anybody else have any questions before we start wrapping it up? On these? What does it mean to sell naked? That means you don't have defined risk. When you are selling naked, that means you're just short the option. So that means that you have unlimited risk to the upside. And if Macy's came out and went to 1,500, then that would be you would be short Macy's at $50. Meaning when you sell naked, it means you don't have defined risk. A call spread is a defined risk strategy, so that is not naked. And when you don't have protection, you're naked. Thanks, Kathy. Does that make sense, everybody? So when you sell naked, that means that you don't have protection. Oh, the question, I'm sorry, do I sell naked? Yeah, I sell naked strategies. But my risk parameters could be very different from you guys. When you're starting out, I would suggest doing defined risk strategies. The reason why is probability of profit increases when you're selling naked strategies, and the reason why that is because you're collecting more premium. So I like to go a little bit further out and sell them naked. A little bit further out than the market maker move, and then sell naked. Sometimes, like with Priceline, the market maker moves stating $80, I'm going to be doubling that to sell naked for sure. All right. Any other questions? Yeah, the question, yeah, you're to do, and you have to be cleared for doing those. You have to be cleared to do those types of strategies also if you're going naked. But Priceline, the margin on Priceline, I think, is like $17,000 for a one lot to sell it naked. So you would have to have a big account. And I wouldn't suggest anybody trading a newer options trader to trade Priceline. It just so happens that was the only one that works with all the rules that comes out on Monday. There's not very many that come out on Monday. ExxonMobil comes out on Monday, but its IV percent is like 23 or something. So that just doesn't make it fit the parameters of trading on a binary event, as far as I'm concerned. I wouldn't even sell XOP right now, or XOM on a long-term strategy, even if they didn't have the binary event, just because the IV percent is so low, it's not worth it. So that might be something where I wouldn't even buy an option strategy in that, because I know that there's still going to be, even though it's only at like 23%, I still know it's going to go down after the binary event, but it's just the risk reward isn't there. I don't think it's going to go from 23 to 3. I think it might go from 23 to 20 or maybe 15. It's going to drop, but it's just not enough to make the risk worse, or the reward is not going to capture what the risk is. Okay. One thing to note, you guys, is we are doing this for one more week. We got this special offer, this last week for it. So if you aren't signed up for it, you might consider it. Get the daily market commentaries where I go over each trade. Like I went over the Disney trade. I don't go as detailed on those as I do in these webinars, but I did go over the different Disney trades that I did, and I go into what I'm thinking on those, why I think that this would be a good strategy for me. And you have to take that into your own eyes. With Tesla, I may have a different thought process. I think that Tesla might be a little bit overpriced right now. It's pricing in so many future things, but I think that Amazon is probably going to take over the world. So and you might hate Amazon. So keep that in mind when you're looking at it. But I tell you what I'm thinking, and put all the economic and geopolitical stuff around it too. So and then these trading options workshops that we have. I also have some like 15-minute videos that we did earlier on, and it goes all the way back to like the beginning of options, like who came up with options, the first idea of an options trade, which was Deleuze from Miletus. And Aristotle even wrote about him. So you go back and learn the history of options, and all the way through till today. But that's that last week for that. That link is in the chat box, so you can easily just link on it, so you don't have to worry about that. Is it in this activity? The workshops, online workshops, are these webinars. The daily market commentaries are, every day sent out. And if you guys ever have any questions and need some help with like how to manage something, I can tell you what I would do. I can't tell you what I think you should do, but I'm more than happy to make sure you guys get the right advice and are doing the right thing. Will asked, is this going to be recorded? Yes, Will. It should be sent out later this afternoon, and you'll have an opportunity to watch it. Thanks for joining us. Sorry you couldn't be here earlier, but you can watch it over and over again. And I would suggest, Will, like I said, for the people that watch this, watch it again as soon as you can. Don't wait like 2-3 weeks to watch it again, because a lot of the stuff will be lost and you'll basically be relearning everything. So Will, when you get it, I'd watch it, maybe wait a day and watch it again, just so everything really sinks in. Thank you. I appreciate it. Thank you. You guys have a great weekend. And like I said, if you have any questions, you can email us or call us at 310-598-6677, or the email is trading@protraderstrategies.com. And if you guys really have any questions or are in a pickle, I would be happy to help you out. And like I said, in future webinars, we're going to be drilling down on these and get to the nooks of these different strategies. I appreciate you guys all taking your time out of your Friday. I'm sure everybody's ready to get out of here, but I appreciate you guys spending time with us. And I like all the questions. I love the back and forth. So you guys, if you don't feel like you can't reach out and throw stuff in the questions box. So I try to read all those and answer all your questions. So ask the question, because there's probably somebody else out there that has the same question but isn't asking as well. All right, take care, you guys. Have a great weekend.